A very good day to everyone present. I welcome you all to this webinar on a preview of Financial Modeling Masterclass by EduPristine. I'd like to start by introducing our presenter for the day. Richard Wesson started his career by completing a Bachelor of Computer Systems Engineering with honors at the University of Technology, Sydney. Over the past 20 years, he has held multiple positions in both the private and public sectors, including Research and Scientific Analysis and Modeling at the CSIRO and UTS, Financial Transaction Processing, EFT and Settlement at MasterCard, Profit and Loss Ownership and Management for Interwoven and Vision 2 Solution, Strategic Planning and Management at Interwoven and Vision 2 Solution. All of these areas have a direct relationship with the creation, management, tracking and reporting of financial models and results. Richard's mathematical, statistics and scientific background combined with work in and with many companies allows him to explain financial modeling and concepts with a good balance of theory and practical application. On that note, I request Richard to commence the webinar.
Thank you very much, Austin, and welcome to everybody who's been able to join us for today's session. I'd like to go through what is really a preview of the Financial Modeling Masterclass that EduPristine provide, and there are some specific sections around balance sheets and income statements we're going to look at, and we'll look at some specific examples along the way. So without further ado, let's begin. Now, one of the things that's specific about financial modeling and any kind of modeling really is there are concepts we need to understand, there are inputs we need to understand, in this case balancing a balance sheet or an income sheet being an input to a financial model, and also there's tools like Excel and things like that that we need to become familiar with. Now today, unlike in a masterclass, I'm not going to go into all of the different formatting capabilities of something like Excel in relation to financial modeling. I'm going to assume that you have some experience with it. In a masterclass, we would go through from first principles. I am, however, going to try to point out how to formulate a model and how to begin it and how to start work on it. And there will be some formatting that has to happen in that, but in the interest of time, so we can get through that a little more quickly and have more time for questions later, I have pre-prepared some of that for you. By doing a masterclass, that pre-prepared, those templates would become available to you and are things that you could then take away. From a trainer's perspective, we want something for you to take away, to go back to your work or to wherever you want to take that and not start from scratch, but start from an established calculated template. So a brief agenda of what we're going to go into today. First thing is I'd like to look at financial modeling, introduce what it's defined as and how I define it and why it's different to regular accounting, for example. And then we'll look at one of the key inputs, not the only, but one of the many key inputs into a financial model for any given organization, and that's the balance statement, or sometimes called the balance sheet. Now, to illustrate how to get that information and what information is in there, what's calculated, what is raw data, for example, we're going to look at an example of a company that we're all familiar with, being LinkedIn. LinkedIn, because they're a US listed company on the US Stock Exchange, we're able to look at their SEC filings, or the Security Exchange Commission filings, for both quarters and for annual reports, and that's a good basis to how we would start building a financial model. The reason I'm using this example is because if you were working in a company that's listed on the financial stock markets, be that in the US on the SEC or an LSE in London or something on the Nikkei in Tokyo or on the Hang Seng in Hong Kong or anywhere else for that matter, these filings that happen yearly and quarterly typically are the best place to start when you want to create a balance sheet for the purposes of a model, not a balance sheet for the purposes of reporting. The difference between a model and a report we'll get to in a little bit more detail later. And after we've done that, we'll start putting some data into a template for a balance sheet, and then we'll start changing some raw data into calculated data. And I think what's really important about this process is for me to take you through where to find what information and how to view whether information should be just copied or whether it should be calculated based on the theory and the generally accepted practices for balance sheets. We'll do the same for an income statement and partly create an income statement. In the real masterclass, we would create it from scratch. And then once we've finished the modeling kind of aspect of today, I'd like to talk a little bit about the upcoming masterclasses that are being scheduled for Singapore. and what you might expect to be able to do, what kind of skills you might have and some rewards you might get after completing that and the necessary certifications with that. Finally, I'll talk about the batch, the specifics of it. That's more commercial information, and we'll talk finally about EduPristine, how we do things, why the training model is good, and why I believe it's a good model to be working with, and I think it's beneficial for people who attend these training courses. So let's start by financial modeling. Really what a financial model's objective is to give us an understanding of how a business is operating, but using the generally accepted reports that are always created by accounting and finance teams and as inputs to that model. And with that, we can then start looking at historical data, and then we can say, let's throw some what-if kind of questions and what-if kind of examples against that model that's been generated from historical data, and try to make some projections or some predictions about how the business might look financially if that was to be the case. A good example of that might be, we have this cost versus revenue picture at this point in time that's giving us a specific margin in a percentage, for example. Now our costs are broken up according to our profit and loss sheet. Our costs are broken up by fixed costs and variable costs. What if I was to change the variable cost by reducing that 10% and moving that fixed cost? How would that make other parts of my business look? If I've got a reasonable model, I can throw that what-if question at the historical data and the model and look at the projection with some level of confidence. Now, of course, depending on the complexity of your model and complexity of the task that you're trying to use, it's also going to, and the size of the data that you're dealing with, be it regular data in a database, could be just a spreadsheet, or it could be something, a big data warehouse. The kind of tools that we would use to do this kind of analysis and this kind of modeling would change. It could be anything as simple as Excel or numbers, and that's what we're going to, Excel is what we'll look at today, right up to something as complicated as SAS or SPSS, the high-end statistics and mathematical modeling packages. But no matter which package you're using and which tool you're using, the best practice is always to create a template. And our template is a structure by which the model is going to be created, and structure with necessary calculations inside it. So as we move from historical reporting through to projections with what-if analysis, the template does those calculations for it. And it's because it's been tested with historical data, we're usually fairly comfortable that it's going to give a fairly accurate representation as we start looking at projections going forward. So remember, a template with calculated data is key irrespective of the complexity of your model or your tools. And we want our model to work off generally accepted reports and inputs because that's easily obtainable for us as the financial modeler. So let's start with one of those very important inputs, being the balance statement. Now, a balance sheet or a balance statement really just shows the financial position of any given organization or division at a specific point in time to the date. And that's why anytime you see a balance sheet, you should see as of a specific date, this is the balance sheet. And that's usually written somewhere very close to the top of the balance sheet, and you'll see that it is written for LinkedIn. Now, a balance sheet contains these three elements. It always has assets, has liabilities, and owner's equity. Now, assets equals the liabilities plus the owner's equity put together, and in the next slide, with this diagram, I will show you what I'm referring to. So as you can see, on the left-hand side, we have assets. How are those assets formed? They're things that a business owns or has access to be able to use, including things like cash. It could be equipment. An asset could be something along the lines of a mine. It could be an intellectual property patent for an IT company. It could be a train for a train service. Any number of things any physical thing that the business owns, or any specific value item that the business owns or has access to be able to pay something with or to do something with, is an asset. Now, I will come back to cash in a minute, because the cash that a business has is not just the cash that the business owns that's generated itself, but it is also cash resulting from a liability, either against the owner's equity or stock equity, or a loan, for example. A creditor may be exempt. So if we look on the right-hand side here, we have the liabilities. There could be claims against assets. So we use an asset to secure a loan, or a creditor or an investor from a venture capitalist or a bank, for example. But liabilities are also areas of things that we own. We owe money that we need to pay. So money comes out from liabilities. But if we have borrowed the money and we now have a liability against the creditor, if we have not yet used that money is now available to use as an asset. And that's why these things need to equal each side. Now the word balance sheet has a very specific meaning because it has to be balanced on both the left-hand side and the right-hand side. And that's part of the self-checking mechanism that's put in place as a result of a balance sheet or an income statement or any of these kind of financial modeling tools. That we will only talk about those two today, but every one would be talked about in MasterClass, and they all need to balance. So to summarize, the liabilities, the money coming in, and the owner's equity, the money that's been brought in, when put together, result in the assets that the company either owns or has access to for use as the general operation. The balance sheet shows these on both sides, and we're going to look at some real ones. Another way to look at them in the same diagram is to put two sides of the balance sheet. Remember I said that the balance sheet needs to be able to check and have a self-check. So assets should equal liabilities and shareholder equity, owner being one shareholder and other shareholders or stockholders in a company being others. The liabilities and stockholders is what comes in. The assets is what goes out. If they're not the same and we're out of balance, there's an item we've missed because we can't spend money we don't have. Whether we've borrowed it or owned it, we can't. So it can't be an asset if we don't have it. So if the assets is less than liabilities and the shareholder equities, we have an accounting issue. Likewise, if we have more assets than the amount of money coming in, it doesn't physically make sense. Unfortunately, people when they first deal with balance sheets and balanced accounting, that's the topic we're really talking about here, they tend to get a little confused because they think, well, wait a minute, I've put the money in, I don't have to pay it out. Why do I need to add it on both sides of the balance sheet, on the left and the right-hand side? So hoping this explanation has been the assets are the sum of everything that's come in that can be used to send out or to be used to pay something out. And that's why the liabilities and the equity must equal the assets. If it doesn't, there's a problem with your balance sheet. And a good balance sheet template, as you'll see later on, has a self-check in there that assists in making sure that you're balanced. So moving along, what does a balance sheet actually look like? Well, this is a sort of a screenshot of what a balance sheet that we're kind of going to create. Not exactly the same. The one we're going to create, I will bring up, is this in Excel. So I've created an unfilled and a filled balance sheet as a financial model. Remember I said that a balance sheet should have a specific date, as of, in this case I've said as of December 31st because that's what LinkedIn's from. And then on one side it needs to have all of its assets and then all of its liabilities and equity put together. And finally we want to have a check down the bottom. So in this case, if this is true, it means the sheet's balanced. Now at the moment it doesn't have any summation data in it, so of course it's going to be true. But when we actually go through, sorry, we're looking at the wrong sheet. When we actually go through at the end of this, we will see that the difference will be 0 and the check is true. I add the difference here because if for some reason this comes out as false here, then seeing the magnitude of the difference can usually give me a hint as to where the problem might be. So moving back to the presentation for a second, I've just shown you what that template will look like. Let's move forward to how we would actually get the information. First things first is we need to get data. As a financial modeler, we need to be able to get access to data. We may not know where it is. So let's just start by looking at LinkedIn as a publicly listed company. So they must provide quarterly and annual SEC or Security Exchange Commission filings, and they can be retrieved from this link. Now, I'm just opening up Firefox. And what we see here, I'm opening Firefox directly to the LinkedIn site. And now I can see that they have annual filings here, or they have quarterly filings that are usually called 10Q. That's 10 quarterly, whereas 10K stands for annual filings. And over on this side, we see that they have a PDF version of that. They have an Excel version of that. They have an, I believe it's an XBRL, that's extensible business reporting language version of that some packages read, or even an HTML one for online viewing. Now, to save time, I've already downloaded these, both the PDF and the Excel file. Why did I download both the PDF and the Excel file? Because the Excel file gives me raw data, the PDF shows me how LinkedIn formats their balance sheet, and that gives me an idea, if I'm not a member of LinkedIn, It gives me an idea how they categorize both balance assets and liabilities, and also how they categorize income. So just to briefly show you that, what we're looking at, just 1 second while it comes up, what you'll be seeing here is the PDF file on page 59, if you were to download this, has the balance sheet for LinkedIn. And see these indentations here? These indentations on the balance sheet show how they view these various items to be put together. Same with stockholder equity. Also, as you can see on their income statement, how they group things and how they don't. Also, how they format things on the right-hand side is important, because then we can start understanding what we're looking at when we're trying to collect data to build a financial model. So that's the last we'll look at the PDF file for the moment, but typically it just gives me a better idea. The Excel file, however, gives me much more information. So let's have a look at the LinkedIn Excel file, because it's a very large document and it's going to look quite frightening at first. Let's just wait for it to come up. Here we go. Now, LinkedIn, their balance sheet, I've downloaded the 2013 February 19th balance sheet. Now what we see here is a whole series of assets. Some of them, like this one here, the accounts receivable, has notes under it talking about various things, and so we see that there are some blank cells here. We also go down, we see some information about stockholder equity and how they're dealing with stock and things like that. We also see cash flow, we see accounts receivable, and what you may have noticed down the bottom is there's all these tabs down the bottom that we have to scroll until we get to the balance sheet and other useful items. Okay, so I'm on the balance sheet here, but there's also income statement, there's stockholders' equity, and there's cash flow. All of these 4 tabs we are going to use to create our financial model template. And the way we would do that is we need to identify what is raw data that can be just copied across and what is calculated data. Now the first thing that's important to note is we need to identify where these data elements come from, or where these individual values come from. Some, like prepaid expenses or current assets, deferred commissions, short-term investments, they look like what we've got here, accounts receivable, they look like just raw values that an accountant or a journal entry person has actually put in. However, the total assets and limited stockholders looks like something that would be a calculation. However, when I look at this field and then look up the top, I see that it's data entered. So now I'm getting an idea what I need to do. Why? Because when I want to start looking at projections going forward, I need this to be a calculated field. So let's now move back into the unfilled balance sheet that I was showing you before. Now I've copied across the raw data here just to save time. It's just the same data. If you were to look at them, you'd see for short-term investments for 2011 it was 238,456, or 238 million basically, because it's in US dollars, thousands of US dollars. In order to avoid just copying across and formatting, all I've done is taken those values and I've made these blue. The reason I've made them blue is just for my personal preferences, so I know what's copied and what's calculated. Notice I haven't taken across cash and cash equivalents. The reason I haven't taken across cash and cash equivalents is because they're coming from somewhere else. So in a financial model going forward, they would also be coming from somewhere else. So we should be calculating them, not copying them. If we calculate them and we calculate correctly, our balance sheet will balance. If we do not, we'll see a difference. Just additionally, we see current assets. So that is also a summation. It's a summation in this case, and let's just put it in, of all of these. So all cash equivalents right down to the assets. And let's just copy that across. Then total assets, again this is another summation, all the way down. So we would do the same with assets and liabilities. We might want to do some changes to data. So let's look at the LinkedIn data again. Let's see what we see down here. For stockholders, we see that there's a lot of information here. First it says preferred stock of 0.01. These are for, looks like Class A stocks, and there's 0. Now the only way I can know that whether they really are zero or not is if I look at the stockholders entity and for that particular year. So which year? We're looking at the year of 2012. 2012 on here, it's over here, 2010, down to, sorry, 2011. It is for 2011, not 2012, my mistake. And I can see that the total net income is 0. So that's fine. If that was a value, the value would be in here. And what else I can see here is they have separated Class A stock being regular stock that any investor could buy, and Class B stock being stock that's allocated for founders or very important specific people in the company that have extra voting rights, typically 10 to 1. So they've broken out here. Depending on what we want to model, if we wanted to model how stock options and how that changed things, then we might want to keep them separate. In my particular situation, I think I'll probably just put them together, and that's what I've done. Because I'm not looking to model that, I'm more looking to model investments around money, expenditure, and liabilities and how that. So I just added them together here. As you see up here, it says 4 plus 6, and this one will be 9 plus 2. So when it's all done, and we get the cash flow that comes out of the cash flow statement over here, so we can see, here we go, the cash equivalents at the end of the period for 2012 were 270, for 2011 was 339,000, and so on. We take those values out and we fill them into here. We'll be able to start generating our model. Now to save us all time, because these are now just summations, let's just go to the filled-in version where all these values are now there. So as you can see, these are copied in, so I changed the color. The reason they're not summations and calculated values is because I haven't built a cash flow model at this point. At one point, if I'm doing proper financial modeling, I'd be building the cash flow model as well, and those figures would be then brought into here, and they would all interrelate. I put the sums in here, another sum in here, and last but not least, I go down to look at the total equity, is the total liabilities plus the total equity. And what I want to do is to identify if we're balanced or not. Now there's a little function here that says if C18 minus C39, and let's see what they are. C39 is the total equity, so when we think about it, the total assets need to be the same as the total equity. If these two values are the same, we're in balance. If, however, one was different, let's make that 0, it says false. We're not balanced, meaning the balance sheet isn't a balance sheet, it's an unbalanced sheet. And whilst this is not necessarily, the difference function is not generally accepted accounting, because we're building a financial model template, I want it to be self-checking. So this tells me I'm out by 339,048. I can immediately look for that number and I see, oh, here it is, and bring it back to balance. So what I'm trying to outline is when we're building a model, we don't have to follow all of the raw data that can't ever be changed in accounting practices, but we are using the balance sheet. We're positioning it, we're grouping things together, we're putting in calculation fields, and we're removing unwanted information like notes about specific types of stock or anything like that to make it the good baseline for a model. And once we've done that, we extend it out. You'll notice up here, I've set this for financial years or fiscal years, but the number is still 2011, so I've just done some formatting. I've copied across calculations. I've copied across balance checking. And the whole idea of that is, let's for example then say that we wanted, in 2013, we wanted the short-term investments to reduce by 10%. I would then be able to start putting in values here, saying this times 0.9. And the model is now self-calculating. And if I do it correctly, I'll either be able to put in proper budgeting information and balance, and then I'll be able to look at, for example, one thing that's very, very interesting to me is the total income. And it's not on this sheet. Sorry, it's, where is it? Deferred revenue, tax, liabilities. I've taken it out of this sheet, my apologies. But my point here is I can start looking for key variables that I want to model because I've now built a good template. Now once again, as I was saying before, we build a template, we make it self-calculating, we make it self-checking, So we have that as a tool. We add it to our toolkit for later work. And as a financial modeler, or any kind of modeler for that matter, that's a very important tool. It doesn't matter whether it's Excel or any other package. The more work you've done up front, then the more questions and the more heuristic intelligence you can use when starting to ask questions of that model, because that's what questions about the business really mean. So moving back into the presentation, I've actually shown in real time what these slides do. So if you get a copy of these slides, you'll be able to follow on later. So it says copy the parameters in. It then says leave some lines. It says add the US dollars and the time. It talks about formatting. It says as any balance sheet requires a specific date. And then it also points out that cash and cash equivalents and other areas for that matter, stock as well, for example, are things that you can't calculate. They're things that you need to get. The things you can't copy as raw data. They're things you need to calculate from either another sheet or get access to other data. It's all there in the filings. So it's just a matter of finding it and linking them together. And once we've gone through that, we end up with a balance sheet that can be used as a model. It's not a balance sheet that we would ever publish to the SEC because it has things that can change. A balance sheet by its very nature at a specific date is fixed, should never change, so that's why it doesn't have a calculation in it. However, if we're going to do something that needs a calculation, something called model, because that's what we're talking about, we want to put those calculations back in. So what I hope I've been able to demonstrate and illustrate to you at this point in time is, if I'm given a commissioned job, or if this is part of my modeling job inside my company, and I need to be able to start doing financial modeling, a good baseline from looking at the balance sheet as an input, I'm going to do the same with the income statement, and building a model that's self-calculating and self-checking is a really good idea. In the MasterClass for Financial Modeling, we'll build multiple ones of these things. So to give you some idea about income statements, because it is another very important, not the only, but another extremely important input into any financial model for any business or department. And the reason it's important is it doesn't just show at a particular point in time, it shows over a particular period of time. Income over a certain financial year, for example, or a certain quarter. Now this is much better because it provides us information not only about cost and assets and liabilities and things like that, it puts it more into language that business people recognize about revenue, expenses, gains and loss, continued, discontinued operations. My times when I was doing a lot of direct management and ownership of profit and loss sheets, income statements were undoubtedly really important to me. And I used to check them, work on them with our financial modelers quite frequently. Now, to graphically talk about what an income statement might look like, really if you take, again, it's a balanced environment. Now, if you take all the revenue on one side and then you break it down into what that revenue is used for and what becomes profit, what portions become tax, what parts are depreciated, that it's not really an expense, it's just an accounting write-off, what's amortized and what's not, you get this. Now there's some terminology in here or some acronyms in here that are not immediately obvious and to understand. So I'm going to go through it. EBITDA or EBITDA stands for earnings before interest, taxation, depreciation and amortization. So it goes to show that even the earnings before income, before interest, tax, amortization, plus depreciation equals EBITDA. Now the point is where you put these things. So what we're trying to do is we take a full bunch of revenue and then we move up, move from the top down to the bottom to get to the point where we have net income. We can start estimating our tax. We can see where depreciation and how depreciation makes adjustments to our balance sheet and our income statement, because that is also another thing that's important for us when we're talking about financial performance and financial reporting as is related to publicly listed companies. Because we might purchase a large training room with maybe $50,000, $100,000 worth of hardware, but we will only have to put the first year's asset in the first year's reporting statement because we'll amortize or depreciate that over time. And that's why the understanding the income statement is critical for any financial modeler. Income statements, just like balance sheets, have data that's copied in, that's raw data. In this case, it's blue. I've done the same thing for you in the model templates. Also calculated data that needs to be put in if it's not already there. So if we copied it from LinkedIn, they wouldn't be calculated. We would have to take those out and change them to calculations so we can use it as also an ongoing model. And we could also throw information to it. So costs and expenses of sales and marketing, if that went up, what effect would that have on net income? If product development costs went down, what effect would that have on net income over the next 3 years if they went down by 5%? We can start putting in calculations like that and asking questions of the model to see how the business looks. To show you what that looks like, I've created the income statement inside Microsoft Excel. Both I have a non-filled in one and a filled in one. The non-filled in one just doesn't have these calculations done. So once again, we've provided a template. Now this red with the brackets means it's a negative value. It's just something to note out. Again, it's one thing to remember. We want these to be as appropriate as possible. Now, the good thing to know is if these things are self-checking. So if we add these three together, made a mistake, but basically what we need to know is that the total cost and expenses when we put all these together should also equal net revenue, and that would maintain that this is balanced. And if you look at these two figures, I think we're probably pretty close. Yeah, so this is 972,309, that's 972,309, meaning that our sheet is balanced. We should probably put in the true and the difference values like we did in the balance sheet as well, just to make sure we're doing a proper self-check. Get that one's correct, and so is that one. Coming back to the presentation. So what I've now covered is creating, I'm trying to get across that all of the inputs that you would need for a good financial model are already readily available in every company. They're available because they needed to be there either for publicly listing situations, and thus they're publicly available, or just because they're good business. Every company maintains a balance sheet. Every company maintains an income statement. They are required to submit it every financial year for tax purposes at a very minimum, let alone it's good business practice to keep these records. So I tried to then say, having access to that and having some financial modeling skill and prowess, we'll be able to take those, calculate the parts that are calculated, and leave the parts that are raw, start linking them together where it's necessary, and finally build a model that we can start throwing questions to try to do some longer-term prediction. And that's what financial modeling is all about. So now I want to switch gears slightly to say that's a preview of what the class would be. That's actually slides from the class. So let's talk about what else is entailed, what else is available in the class. The good thing is the class is intensive training, and it's 4 days of that, and then you are trained by industry experts. People who do this stuff every day. There's a reason I know this stuff. It's because I've done it. I had to do it for a real situation. I learned it. I also had to learn how to do it. And having access to a trainer like myself or another trainer who's an industry expert who deals with these things daily or weekly or whatever, just adds somebody to your network and also allows you to extend beyond what's written in course material to ask real-world experience. For example, every time I come in, I don't give examples that I know will work. I say, let's do it together, and if something goes wrong, let's work it out together, because then that will be much better preparing you for what happens in the real world. But not only in the intensive training where we go into extensive detail, there's also a lot of video tutorials. There's 20 hours here, plus online material. We also give the sample financial models, the sample workbooks, some PDF guides on how to deal with that, just like the unfilled and the filled in Excel sheet that I gave you, or I showed you. There's also the 24/7 support for doubt clearing. Doubt clearing, everyone has doubts when they're learning. Doubt clearing is a mechanism that through forums and through trainer moderated or trainer monitored forums, it's just a way for us to say, as a trainer, we have a mission to impart as much knowledge and experience that we have into you so you can use it. Doubt clearing is just another way that we do that. I think one important point, though, about the training program is it serves as credit hours for some university degrees and is also approved by GARP and the CFA. That means that whatever qualifications and certifications you get from EduPristine's Financial Modeling Masterclass will follow you worldwide. They're recognized worldwide. That's very, very important because, as you'll see shortly, the kind of companies that are interested in this thing are interested in certifications. So let's now fast forward to the hypothetical situation that each of you have joined the class, have completed the class, have received the certification. Now, what is it that you can expect to be able to do afterwards? What are some reasonable expectations? First is you can create robust, easy to maintain financial models in Excel, just like what we did. And more importantly, they're error-free or limited errors, so it's hard to misinterpret the data and make bad predictions or bad reports. They're self-checking. They follow best practices. The self-checking part that I put in is a best practice to eliminate a pitfall of we're not noticing when we're not balanced. I think also when you've done that and you can talk about, okay, well I know that I've got a self-checking mechanism in here. I also know that it points out the difference. That shows to anyone that you're talking about that you're thinking. You're wanting to make sure this is done correctly. And so if you've gone through one of these courses, you've learned this is just one tip and trick. There might be 10 or 20 that come out. That can make you very, very helpful and a really good, valuable resource to not only the team that you're there or to any prospective company you might be talking to. And one of the other things that just comes, we didn't go through it today, but would come through with the practice of these financial modelings, is you learn some good tricks. There's a lot of shortcut keys in Excel. There's a lot of ways to copy and fill things left and right. There's a lot of way to copy formatting or formulas and things like that. So as the more you use Excel for financial modeling, the more some of these tricks come in. The other thing that's also important to note is financial modeling obviously has some mathematical computation associated with it. There is a vast array of functions in Excel and numbers and any other package like these that you'll start becoming more used to and recognize how they can make your life easy. So the next batch of the masterclass, I'm sure you're all eager waiting to get to this, is very soon. It's just around the corner. 22nd of February, there's a 2-day or a 4-day masterclass, and their costs are there. Clearly the 2-day one will have won't go as far as the 4-day. Now, if you're interested in this, John Comici is your contact person. His details are there, along with a phone number to get in touch with them. I would recommend that it's a good class, and this one is conducted in Singapore. So the last thing I'd like to discuss is the corporate profile, and tell you why I'm proud to be able to work with EduPristine and why I think they're a good training option for anyone who is looking to either enhance their career, further their career, or become more valuable inside their own organization. They're about the fundamentals are good. The business is well set up. There's a lot of courses, so a lot of offerings. So operational in a number of regions around the world, the US, Singapore, and areas like that, including Australia, where I am. And it has gone about the necessary discipline and procedures to get the certifications to make sure that all of the students that come and graduate are students that are recognized in industry. So the business model, I think, is good. The investment and management team, as you can see here, are all coming from very well-established backgrounds, and they're good. And the other thing that makes a good management and a solid management background and board, the other thing is they use trainers like myself and course developers like myself from around the world who are subject matter experts in various areas to try to make sure that any student gets the most valuable and up-to-date course material as possible. Now, it's proven that this business model is well established because there's thousands and thousands of customers, especially a large number of them in the Fortune 500, that have taken on EduPristine as a training provider to not only train their own people, or in some cases educational institutions to train their own students. That's a pretty important and a pretty big thing to do. And when you think about why they might do that, it's because industry experts are doing the training. There's a lot of case studies, there's a lot of hands-on and models that are provided to try to help. And to match with that and to help work with that and supplement it, if you like, or complement it, sorry, the online technology platform for allowing for your own pace learning, both through video or through written descriptions and through forums. This gives you one more chance to be able to make sure that all of the material you have learned has clicked. So there's 4 of them listed here. There are other ones as well. The important thing is they're dealt with the financial related certifications, and they are internationally recognized. So if you have a CFA related certification or a GARP related certification, you can rest assured that you're doing okay, and that other people around the world, if you move or into international companies with human resources departments in another country, they should recognize your qualifications. A large number of Fortune 500 companies have recognized the model as a good one. I've had personal interaction with 7 of the 8 companies listed on this slide. The only one I haven't is Franklin Templeton. And when I've done training for people like Mizuho, HSBC, or Credit Suisse, or ING, various parts of the world, Mizuho in Japan, Credit Suisse in Japan, ING in Amsterdam, JP Morgan in the US, HSBC in Hong Kong, I've been interviewed by a number of these companies to determine whether I'm suitable to train their staff. So not only does the reference material important, they want to look at the material, but they also want to talk to the trainer and they want to say, are you qualified to teach my staff? And if you are, we're going to allow you to come in and we're going to have an enterprise discussion with you. Now this was actually with in a different situation that I was dealing with them, but given I know how these kind of companies operate because I've had to deal with it firsthand, the fact that EduPristine is in them and is able to do workshops for their staff or various departments of those is a real credit to them. And that's one of the reasons, a very important reason, that I believe that EduPristine is a good training provider for you. But not only companies who are customers, but education providers like the National University of Singapore is a company I've worked with directly for many times. And I've taught inside them as well under different models. Again, they are an educational institution and they teach people. So to allow an EduPristine trainer to teach on behalf of NUS inside for an MBA program, for example, is a pretty important and a pretty interesting thing to talk about. It only goes to show that the model and to validate the model that EduPristine has. And as I said earlier, that's one of the reasons I'm quite happy to be associated with that by working with EduPristine, because I believe their fundamentals are good, I believe their training models are good, their course content is very definitely good, and they do allow trainers who are industry experts like myself in various areas to help and make sure that students are able to take away one or if not many more things from a training course and also add a mentor to their network if necessary. Now, people from all around the world have done this. It's important to note that if you can deliver training in both masterclasses and also online training in multiple parts of the world, you open up the door to other departments inside your organization or places where you can actually do that. Now, currently, there's more than 40. Australia, New Zealand, and South Asia are the ones that I'm aware of. But there's things in South Africa here, there's South America, there's North America, there's Europe. That's a very good cross-section. In addition to the number of countries, there's also a very large number of courses that are available, and they're varying different areas. So the ones that I'm related to are around modeling, they're financial modeling, they're around business analytics, they could be around wind power, they could be around equity valuation. But I'm personally not a real estate modeler. I'm not an equity research person. I'm certainly not an investment banking person. And as a result, they've got different experts out there that will train those courses. So I train some, other people train some, and the end result is you as a student will get, or you should get, an excellent trainer with a lot of experience to help you with your learning achievements. So based on that, I think I'll bring the presentation to a close, and I'll say thank you for your attention. I hope I haven't given you too much information or overloaded. I would certainly recommend that the masterclasses are discussed here for both 2 and 4 days in Singapore are a good idea. And if you would like to find out more about them, please get in touch with John on the contact details that are here. So based on that, I will now turn back to Austin to open the floor for questions, in case you have any questions for myself or her.
Hi everyone, I hope you had a good time. Does anyone have any questions? And if you do, please post them. Any further questions? If nobody has any further questions, then I'd like to conclude the webinar. Thank you everyone, thank you for coming, and thank you Richard, the presentation was wonderful.
Thanks very much, Austin, and I'm glad it was helpful. Thank you everyone for attending.
Yeah.
Have a nice evening.
All right, bye-bye.